Good morning, everybody. Good morning and welcome to today's webinar. Thank you for joining us. I'm Ben Wright, Chief Innovation Officer at Melo, and I will be your host for today. I am also joined by Melo's CEO, Vicki Hicks, and Ben Goodwin, Director and Actuary at Compliance Experts Isio. So today we're going to be talking everything DB transfer, but particularly when it comes around to selling a business. Because DB transfer history can affect valuation deals, structure, PI, premiums, or even whether a buyer will engage with you in the first place. If you've ever done any DB benefit business in the past, you're probably wondering what impact that's going to have on the saleability of your business. And today is about removing that unknown by showing you what it what actually matters and what buyers genuinely care about, and also what you can do to strengthen your position. For anyone new to Melo, we help financial planning firms become more profitable and their owners exit in the right way. Because we help so many owners sell, we know exactly how buyers think about this particular topic. And we wanted to team up with Isio, who are experts in DB, redress and due diligence, to give you the inside track and put you in control when it comes to selling your business. Now, a little bit of housekeeping before we get started. This session will count as structured CPD. We will send you a certificate out after the webinar along with the recording. As we go, please pop any questions that you've got into the Q&A box and I will make sure we tackle them throughout the debate. You will also hear real examples from real transactions so you can see how our advice plays out in practice. And of course, we will have some dedicated time for Q&A at the end. But to kick us off, Vicki, why don't you set the scene?
Hi, everybody. Good afternoon. Ben, it's the afternoon. It was 1 minute past 12 when you introduced yourself. Time goes so fast in Melo. That's it, isn't it, Ben? Time flies when you're having fun. So good afternoon, everybody, and thank you for jumping on today. Just to pick up on something there that Ben said in the intro, which really resonated with me. He used the line, "It's about giving you control when it comes to selling." That is what we are all about here at Melo, right? It's about helping business owners to understand their business, to understand the gaps that might exist within their businesses. So not just the opportunities, but any potential weaknesses, anything like that needs to be addressed well in advance of sale so that you take control over your exit process. So Ben, thank you for that line. I've written it down there and that's brilliant. So what are we here to talk about today? Well, Ben, there we are. There's our mugs. So you've got myself and the two Bens, like a rose between two Bens this morning. So
Two Bens are better than one.
Two Bens are better than one, indeed. Just flick over to the next slide for me there, Ben. Okay, so why are DB transfers a flashpoint? I think it won't have escaped any of you just how important it is that you understand what your DB back book looks like. This is still a major issue for buyers and will remain so, as this is high risk business that has been transacted, and it's also highly politicized as well. You know, there has been a lot of speak about DB transfers, whether these were done for the right reasons or the wrong reasons. It's been in the press. And naturally, as you would expect, it is a major part of a buyer's consideration when they are both looking at a business initially and whether to have conversations with that business owner. And of course, when it comes to the due diligence part of any sale process, these are very much scrutinized. There are a lot of buyers out there that unfortunately will not consider businesses with defined benefit transfer liability on the books, or will only consider it if it's a very small amount of your overall book, or, as we're going to go on to explain today, will consider it if you have undertaken a review of that past book and you've made improvements. And that's something that Ben G is going to be covering in quite a lot of detail today. Over to the next slide for me, Ben. So it starts with, of course, really understanding what you've got. Could you speak about your defined benefit transfers with confidence? You should know where they have come from. You should know where they are right now. They should, of course, align to and match with all of your clients' objectives. They should become the focus of every future review to ensure that what clients set out to achieve at outset, they are doing through the transfer of the DB book. And what you've got to be really aware of are what are those particular DB cases where the spotlight is going to shine even more brightly. And that's again something that myself and Benji are going to dive into today. What are those? Not all cases are equal, shall we say, and there are some DB cases that are looked at with a lot more scrutiny than others. Next slide for me, Ben. By understanding what you've got, what we can then look at doing is drawing a line in the sand. I know that DB transfers continue to keep a number of business owners awake at night time. Quite often, this isn't driven because of clients. We hear a lot the clients are happy with the advice that has been provided. This is driven through the regulator and through this ongoing spotlight. So by understanding what does your DB back book look like and potentially taking the reins on reviewing those DB cases in the same way as a buyer would during their process anyway, by doing that today, can you draw a line in the sand? Finally, be able to sleep comfortably at night time, knowing that you have reviewed those DB cases and have that ability to approach the market with absolute confidence, with a full audit that's taken place on those DB cases and any potential redress they're dealt with. Over to the next slide, Ben. We're going to touch upon as well what are the regulatory expectations. And what we mean here is not the regulatory expectations around DB transfers. I think we all know a lot about what that looks like. What we're talking about here is what are the regulatory expectations of buyers. So later on in the presentation, Ben and I are going to talk about share sales versus asset sales and why in the past asset sales were done where potentially firms had DB liability on the books. The buyer wasn't comfortable acquiring the shares and therefore have shifted the deal structure to an asset purchase. But actually, the FCA have recognised this and starting with consultation paper 2324, actually started to lay out what their expectations were of buyers. So that's going to be something that's going to be really interesting for Ben and I to dive into. What are the risks to you guys in terms of whether you are wrapped up in a nice business structure and therefore can potentially see an end date to this liability window versus being a sole trader? And some of you may have seen the recent case that's been going through. We run a networking group or a community, I should say, called Life Talk on Facebook. I'll take a moment just to do a little shameless plug of the Life Talk advisor community. 4,500 predominantly UK-based financial advisory professionals sit in this group, chew the fat, support one another, offer that peer-to-peer support. And there is a chap at the moment who's been posting into the group because he has been caught up in some previous DB advice going back to the 1990s. And as a sole trader now, 15 years on into retirement, has found himself with some quite challenging matters to deal with. So we are going to touch upon that as well. And then, of course, we want to wrap it all up with some actions that you guys can take today. So we like to make meaningful change when we're dealing with businesses. We don't just like to talk hypothetically. We want to send you guys away, taking some advice from Ben, who sits in this space all the time, with some key action points that you can implement straight away and start to make those improvements. So without further ado, that's the end of the slides. It's not going to be death by PowerPoint today. It's just going to be me and the two Bens having a good old conflab around this topic of DB transfers. So Ben Goodwin, can we introduce you to the guys that are listening in today? Tell us a bit about your background. And then perhaps we start with what is DB? Why is this a big focus and why does this remain a big focus? And what is redress? Over to you, Ben.
Yeah, fantastic. Well, thank you, Vicki, and thank you both for having me on. I'm really looking forward to the discussion today. So, yeah, I'm a director at Isio. Isio is an independent consultancy which provides a wide range of services to companies on pensions, wealth, and employee benefits. And we're pretty large. We've got 1,400 employees across 10 UK offices. And within Isio, I lead a team which supports firms in understanding, managing, and mitigating costs and risks associated with regulatory challenges. And we offer a broad range of services, but our background is really pensions. And we've got a huge amount of experience in supporting firms and working with the FCA on DB transfer advice, risk analysis, and remediation. And so, yeah, if we just set the scene a little bit in terms of what are we talking about? Well, we're talking about defined benefit pension transfers. I mean, arguably, we could be talking about any transfer of safeguarded benefits, which are any benefits which have some form of guarantee or promise as part of the accumulation phase. But by far the most common type of safeguarded benefit is DB pension transfer advice. And what we're talking about is transferring from a defined benefit pension scheme into a defined contribution DC pension scheme and the advice given as part of that. So why is it high risk? Well, it's seen as high risk because it's an irreversible decision for the individuals making it. And given the size of transfer values, it typically represents a significant proportion of a consumer's net worth. Then you couple with the fact that transferring from a DB scheme to a DC scheme results in a change in the level and nature of risk that consumers are taking. When you put all that together, it's an area where there's potentially a high risk of consumer harm where unsuitable advice is being provided. And then, as you'll all know, alongside that, you've got the FCA rules, which require that advisors start from the presumption that they shouldn't recommend a transfer unless it can be clearly demonstrated on contemporary evidence that it's in the client's best interest. And the FCA did consult a few years ago on changing that starting point to making it more neutral, but ultimately they decided against that. So it's a relatively high bar that advisors must meet and, more importantly, be able to evidence to demonstrate suitability. And now, why is this high risk for buyers and why is there so much scrutiny? It's because the FCA has been very active in this space for a number of years, and the FCA has undertaken multiple phases of review of the DB transfer advice market, primarily looking at the period 2015 to 29, but also onwards, and find high levels of unsuitable advice. Broadly across that period, across their various work in that space, the FCA found about 50% of DB transfer advice could not be evidenced as suitable. So it was either unsuitable or there are material information gaps on the files provided, which meant they couldn't clearly demonstrate that the transfer was in the consumer's best interest. So whilst all DB transfer advice is going to be of interest to purchasers and to the FCA, in our experience of working on a number of transactions and lots of firms with advice, the biggest risk area is advice, particularly between 2015 and 2018. And the reason for that is freedom and choice came in 2015, which really changed how consumers could access their benefits in defined contribution schemes compared to defined benefit schemes with all that additional flexibility. But the FCA rules in force didn't materially change until about 2018. And so you had a lot of firms who were trying to provide advice in this space whose advice process perhaps didn't evolve as much as it could have done with the changing landscape during that period. And that led to a lot of advice which potentially couldn't be demonstrated as suitable. Now, the advice processes have improved across the time period, but it's still a high risk area. And then we'll cover this more as part of when we get into our Q&A, but in terms of redress on DB pension transfer advice, where advice is found to be unsuitable, well, what is it and what does it look like? So the purpose of a redress calculation is to put a consumer back in the position they would have been if not for the unsuitable advice. And the FCA published new rules on this in April 23, which are now in DISP. Broadly, it's a point-in-time calculation comparing the value of the benefits they now have in a defined contribution scheme against the value of their benefits in a defined benefit scheme. And there's lots of prescribed assumptions. These are technical actuarial calculations with quite a lot of nuance. And they are linked to market conditions. And we'll talk about more in our Q&A around some of the considerations around that and the timing of redress calculations. And then linked to all that, you also have your PI cover. And what does the PI market look like? PI premiums around DB advice really spiked a few years ago due to the FCA scrutiny. And lots of PI cover now could have exclusions around DB transfer advice or certain types of advice. Now, I think there's been a bit of a softening in the PI market more recently, and we're not at the peak levels of, say, 2020 to 2022, but PI cover is still a challenge in certain areas. So I think that gives a very high level background to kind of scene set for our kind of deeper dive conversation.
Thank you very much, Ben. That was really useful to give us a view on things. I think something that I'm really interested in, Vicki, is how when firms come to us, how much do they know about their DB book? Are they like, I know it all inside out, or are they like, oh, I've done some stuff, but I'm not quite sure?
Yeah, it varies. And you know, it's not about just you having confidence in your own DB book. When you go to exit, it's about the buyer having confidence that you, as the business owner, have those real tight controls and that awareness of exactly what your business looks like. So, really doing a deep dive, you know, into what do those cases look like. And we have a document that we pull together for sellers, which actually I think could probably be useful for anybody that wants to do a review of their DB book. So if anybody wants access to this spreadsheet that we've got, just drop us a line or something and we can send it over. But yeah, in there, we're really encouraging business owners to not just look at what the output was from the DB case, but actually to understand kind of all of the nuances and the features about that case that could be scrutinized. So, what was the age of the seller, for example? What was the critical yield? What other assets does the seller have? How far were they off retirement? There's a number of like really important factors there that can reduce or increase the risk profile. I think one of the things that sellers or potential sellers find most frustrating, and this might be one back to you, Ben, because it was something that just aligns with what you were saying earlier on, is there is some frustration that as people's processes have improved, those cases are still going to be assessed on the documentation that they had at the point that they offered the advice. So, you know, if people have made improvements to now, that doesn't necessarily mean that the old cases, you know, are suitable. They would be looked at through the lens of at the point that they were written, and that is a big frustration. But yeah, get hold of your DB book, really understand them, how many clients, where are they, and we'll go into a bit more detail on that as we run through the today's event, Ben.
And I think that's, yeah, thank you for that, Vicky. Obviously, Ben, your firm specialise in doing past business reviews and reviewing these books. If a firm wanted to start this process themselves, where would they start and what would they need to kind of put together from a data perspective to really get that understanding?
Yes, I think as Vicky says, I think understanding your past book is really, really important. And what you do with that past book and how buyers will approach it will depend on the risk rating of it and the scale and size of it in the context of the wider business. I think, as Vicky says, there are certain things that buyers will look for in terms of risk characteristics, which would increase or decrease the risk associated with that book. And it varies based on advice process, but I think some of the really big ones are the age of the individuals at the time of advice. Typically, the further away an individual is from retirement, the less certainty they will have over their retirement objectives and needs, and therefore that potential higher risk of unsuitability, or the more challenging clearly demonstrating it's in their best interests. So we have seen more recently that firms increasingly declining to advise individuals who are, say, under age 50 because of concerns around that. Now, there is no problem with providing advice across the spectrum of ages. It is just there's more of a challenge in terms of the demonstration and documentation of it, and there's a higher bar. Other areas are things like concentration risk among individual advisors or among individual DB schemes, and also the proportion of cases which are being recommended to transfer out of your total book where advice is provided, and any proportion of advised versus insistent cases. So number one is get your data in order. A second really, really important part as you look to approach a due diligence process, any purchaser is going to want to look at some of your case files. And we have seen numerous examples of where challenges arise is where the seller hasn't really thought about things and got their house in order in advance of DD starting. And they provide those case files, but they're provided really by someone who's doing it in a rush, who isn't close to the cases, and they provide what's on the system across. And we have seen time and time again from doing DD ourselves buy side and then trying to work on the cases post acquisition. And it turns out that the position that was shown by the seller was actually worse than the reality because they didn't provide all the wealth of information about the cases. And so that can have an impact upon deal price or even transactions proceeding. So it's really important to get your data in order. And then just to pick up on the point you made, Vicki, around what you're doing in the future versus what you're doing now. You're absolutely right. The FCA will ultimately expects when you review these cases to only review based on contemporaneous evidence from the time. So it's all about how good your documentation is and can you evidence it from the file what good looks like. Anything you do in the future around making sure it's still the right outcome for consumers, etc., that doesn't directly impact the suitability assessment, but would factor into any redress later on if it got to that point.
And let's say that your documentation from when the case went through was okay, but you still remember that case clearly. Is there anything that you can do to help, or is it's happened, it is what it is?
Yeah, again, in advance of a DD process, it is, if you're going to be sharing cases, it is helpful if the advisor from the time is still there to perhaps document. If you don't have the paper trail of it, at least documenting their understanding of some of the wider aspects of it. Different third-party file reviewers will take a slightly different view on that, but the more information and holistic view of a case you can provide, that will massively help with positioning your book in the best light if individual cases are reviewed.
Thanks, Ben. And Vicki, how important is the client's voice in all of this? So if, let's say that there was a DB transfer that happened, I don't know, 5-6 years ago, every year since the review has happened, the advisor's documented, you're on track, we're happy you're going to achieve your goals, you know where we're going with stuff. Does that count towards anything?
Yeah, not really. I mean, the only time it does count, and Ben will go into this in a little bit, is when you go through the process, if you do as a business of saying, I'm going to review the back book. And at that point, you essentially give those clients that are going to be part of the review the right to sort of opt in or opt out of that review. So I suppose at that point, then clients could say, well, you don't need to review my case. I'm happy with the advice. You're still advising me. It's all working. So on we go. And we see this play out during the due diligence process. So some of the acquirers that we work alongside, they have a standard which is we review every single DB case. So I've got one example going through at the moment where the client had 12 DB, or the seller, sorry, I should say, had 12 DB cases. They're all being reviewed. One of those DB cases came back as unsuitable. Unclear, because they couldn't find information. I think it was to do with income and expenditure for the spouse or something like that at the time. They spoke then to the client to try to fill in those blanks because they wanted to take it from being unclear to being suitable. So it wasn't found as unsuitable in this scenario, it was just found as unclear. Ultimately, going through that process, the client was able to find some paperwork going back to that time around their income and expenditure, but they made the decision in that they didn't want to be part of the review, and they were more than happy. They were actually really pleased, though, that the firm had come to them and said, which I think is sometimes a fear of business owners, is, am I opening up Pandora's box here? And what are clients going to think if all of a sudden they get a letter saying, like, we're going to do a review? Are they going to automatically think that we've, not been doing things correctly? And actually, in that example, the client were really pleased that the business is taking stock and they are doing a review and, making sure that everything's right. And it hasn't had any impact in that scenario. But like Ben said before, ultimately it is about what is on file from that point, and at the point that that advice was penned, was the advice suitable then? And one of the misconceptions, I think, across business owners quite often is it was done years ago and the clients are really happy with the advice and they've not complained about it, so surely that's enough. Unfortunately, that doesn't mitigate the fact that it might have been unsuitable at the time. And if a buyer does a review, which they're highly likely to do, and they find that out, they could take control of that narrative rather than you as the business owner. Ben, I don't know whether you'd add anything to that.
No, that's very much our experience as well, Vicky, in terms of we work with a lot of business owners, often who've given a lot of the DB advice, who are quite frustrated because they know they gave good advice, in their opinion, based on knowing their client, and also that the clients received a good outcome. But it all lives and dies by what is documented on the file at the time. From a regulatory perspective, the buyer needs to be confident that if a review is done, or indeed a case went to FOS, that there would be sufficient evidence there to reach a suitable decision.
Thank you both. We've had a question come in. Should you be informing your PI insurer to gain their permission before conducting a review? And certainly if the client is to be asked questions relating to the advice given. So should you be asking your PI guys before you start a review?
The short answer is yes, absolutely. It's important to engage with PI at an early stage, certainly before communicating with any clients, or indeed before getting to any firm suitability outcomes, because you certainly don't want to invalidate your PI. Different PI insurers have different views and approaches, but if you can explain the rationale for what you're doing and do it in a structured, sensible way, which limits risks but also leads to good consumer outcomes, then generally they will be supportive of it. But yes, speak early to PI, definitely, in my experience.
And is it just a case of kind of getting in touch and saying we're thinking about this, or is there a more of a set process to go through? I think some people might be worried about opening a can of worms, maybe by saying they want to go back and review things. Any top tips?
It really depends, again, on what you want to do, why you're doing it, and what you're doing in the context of a deal. For some firms, doing a full past business review right off the bat is absolutely not the right answer. For some, it will be doing some risk assessment. It will be doing some spot file checks. There'll be different approaches that can be taken. So we're certainly not here saying that everyone should do a full past business review immediately. It very much is individually nuanced depending on the circumstances of the business, the scale of the book, and the considerations around any deal. But it's ultimately a decision around from a PI perspective. As long as you consult early, then the approach they take will differ.
So at what point would you say there, Ben? So if a firm comes along to you and they says, right, Melo have told me to speak to you, Ben, because I'm looking to sell my business in 3 years' time, and I've got 10 DB cases, and I'm thinking that now's the point to fully review them. How would you explain to them in that scenario the thing that they do to kind of kick the process off, and then the point at which they engage with PI?
Yes, so you'd want to engage with PI once you've formulated a plan on what you want to do and a clear rationale for why you want to do it. If you had 10 cases, you would make sure you gather all the data so you've got the case files. You'd speak to PI at that point, I think, before reviewing any case files, to explain what your approach is going to be. And when you're going to look at any full population, you've broadly got two options. You can either review those case files for suitability without contacting any consumers, or you can contact the consumers first and offer them the opportunity to opt into a review and then undertake the review of suitability.
And if you offer the ability to opt in and the client says no, does that in effect kind of kill the opportunity for them to come back in the future and complain around things?
Yeah, so the reason that opt-ins are done is because without an opt-in, you don't have a valid claim, and thus PI won't cover it. So there's a requirement to do an opt-in from a process perspective. If an individual opts out in a past business review, the FCA is comfortable with that, and therefore there's no further action actively required from the firm. It also kicks off the time barring element around 3 years from when you could reasonably have known you had potential to complain. So the individual still retains the right to complain for 3 years post that letter. But in our experience, the likelihood of that is extremely low when they've chosen to opt out.
Thank you, Ben. We had a question that was submitted earlier on. Thank you for the person that sent this one in. We're thinking of selling in a couple of years' time, and we have some DB liability. How does the PBR process actually work? So I assume that this would be they'd be engaging with someone like you, Ben, to have a third-party review of the past business.
Yeah, I think there's as I said, there's a variety of options available. You could look at a sample of cases and then take a view that actually things look good or don't, and then decide on some risk-based action off the back of that. if you were to go and review a book of files in full, you would do an opt-in process where you give individuals the opportunity to opt into review. If they opted out, there'd be no further action required. If they opted in, you'd undertake a suitability review to consider whether the advice given was suitable or not. The outcomes would be suitable, unsuitable, or material information gap. For those suitable cases, you would write to the individual to confirm that the advice was suitable and that nothing further is required. For the material information gap cases, which is where there's not enough information to conclude on the outcome, you would write to the individuals, or you check your own files in the first instance to see if you can obtain the information to close those gaps on what is materially missing. And then you would form a view on the outcome. And then if a case is unsuitable, that case would then need to proceed to a redress calculation.
Very good. I just want to add a little bit of a plug here, Ben, just for a moment. So we do, when we're taking people through the exit process, the first phase of our process is what we call our exit readiness assessment. That's ideal for any business owner that's up to 5 to 7 years away from exit, but does also form the first part of our exit process. So what we do there is we essentially allow business owners to look at their firm through the eyes of an acquirer. So we understand the things that sort of a high level acquirers are going to be interested in, especially when it comes to matters such as defined benefit transfers. So that's a big area of our initial assessment. And then what we do with business owners there is essentially the first stage of what Ben's talking about, which is let's really help you to understand what you've got. Let's pull all of those cases together into one document that we can really easily then highlight any concerning trends, any higher risk cases. And then from there, we can help you to plan for whether or not it's right to get some of those cases reviewed. Do we introduce you to a firm like Isio, etc.?
Thank you very much. And just for clarity, I suppose, you said at the beginning whether you choose to do a sample or whether you choose to do something bigger than a sample. What will be the defining factor, Ben? How would you decide, actually, I'm going to do 1 in 10, 1 in 5, 1 in 20? How would you make that decision as a firm owner?
So again, it really depends on the scale of the book. So if you've only got 5 cases, then it would seem sensible just to review all of them. If you've got 100 cases, that's a bit more of a significant material undertaking, and you'd probably want to minimize the number of cases that you're opening. If you're going to review a sample, we would typically recommend reviewing a statistically significant sample based on some criteria that FCA set out for where the thresholds for statistical significance, because then you have something actually tangible and weight you can put behind it. We often adopt this approach with firms, particularly with larger books, because if you get to a strong enough suitability rate, you can probably just stop there, and it gives a high degree of confidence in terms of the suitability of the past book and the low risk of unsuitability. But equally, it helps you to potentially identify risk cohorts as part of that. So then if you do need to open up some other cases, it's a smaller subset of your population and you're not opening up everything. But again, it really depends on the business. For some businesses, there potentially won't be a need to open any of it up. You'll have no complaints history. You might have had positive correspondence with the FCA on this. The risk characteristics of your book might be really, really low risk in terms of everyone's at retirement age, for example. They're all high net worth individuals. Some of the typical characteristics are more likely to be suitable advice. So it really is, there's a range of options available. Which one's right for an individual business really depends on the makeup of the book.
Yeah. And I think as well, whichever kind of route you go down, what a real powerful story to a potential acquirer, to say that you've taken that initiative, you've taken a moment just to, go back at the previous advice that's been provided and to take a proper look at that through this process. So, doing anything can really help to support that positioning in front of buyers and that confidence that they have in you.
Yeah, absolutely, because ultimately buyers are going to look at this. And so it's whether or not you want to get ahead of it and frame the narrative and position things in the best light, or let them take control in a time pressured DD circumstance, which is likely going to make it more difficult for a seller.
I did want to ask, Vic, so if someone has engaged and started this process, maybe they've done like the selective reviews, they've done reviewed 10%, 20%, and they all look okay. How does that impact a deal versus someone that's done nothing or someone that's done a full past business review?
I mean, a full business review is obviously going to be great. It's like a full service history on your car, and this is why we talk about the longer you've got to prepare for exit, the better. Because if you can show a full service history that doesn't just cover the DB book, but covers, annual reviews for the past few years, annual compliance audits and stuff like that, then this is the way that more and more sellers are going to be able to stand out in what is a highly competitive space, right? And the exit space is going to get more and more competitive with the number of sellers that are going to come to market. Things have slowed down with some of the buyers as the consolidation review is taking effect, as integration is taking priority. So if you're thinking of selling in the future, you've not just got to think about selling, but you've got to think about, how am I going to stand out if I land on the desk of a buyer and they've got 4 profiles to look at? Why are they going to look at mine? And when we're presenting a business to market, if we can present a business in saying, they've had this done from a compliance perspective in terms of previous audits, this is how they manage internally around their reviews, this is what they've done from a DB perspective, but guess what? We understand them all. We've highlighted the ones that were particular high risk, such as the ones under 50 or the ones that were congregated around a certain scheme. And this is what we've done about it. That is brilliant for a buyer, because it's going to instill that confidence. I'm going to keep coming back to that word. It's going to instill that confidence in the buyer and in what they're acquiring. But also then it's going to reduce their costs at due diligence as well. The cost for a buyer to take a firm through due diligence can easily be 6 figures. In particular, some of the larger acquirers, they're having every single DD process run by external consultants. So they'll have an external compliance agency looking at the regulatory piece. They'll have an external tax company that are looking at the financial due diligence. And it's really easy for their costs to rack up. And again, as you would expect, when a buyer's looking at a range of opportunities, they're like, we want that one, because those sellers have got an understanding of their business, tick. They've already undertaken some of this work. So in effect, they've done some of our work for us, tick. They're obviously not hiding or burying their heads in the sand when it comes to their DB book. And they will take that work into account as part of their due diligence process. And I know Ben will find that when some firms are coming and using, those guys, that actually then they're able to use that reporting as part of their due diligence pack when they're going to market.
And Ben, from your perspective, because you do buy-side DD as well on firms, if someone comes to you having done this, does it just make your life a whole lot easier?
Yeah, absolutely. It makes it much easier, and it also simplifies the DD, and almost everyone's aligned on where the time on the DD will be spent on some of those riskier areas. Where the seller has done no work, or was just saying our DB advice is fine, but there's nothing to substantiate it, that it makes it much more challenging for buyers. They're likely to request everything, look under every rock, and it likely leads to a position where they have more concerns about the suitability of the advice as a result of that, and that either results in them pulling out of deals or requesting indemnities, deferred consideration being withheld against things, etc. So a weaker position for sellers.
Thanks, Ben.
Yeah.
Another question comes through. If you use third-party companies to give DB advice, do you still hold any liability moving forwards, or is the liability continually held by the third party? So I'm guessing this is where you outsourced the actual DB transfer advice and then brought the client back in afterwards to kind of do the ongoing servicing. Where does the advice sit, or the liability sit?
Over to Ben for this one.
Yeah, so not a lawyer, obviously, but the advice sits with the firm who the regulated entity with the permissions to provide that advice. However, there have been some FOS cases where they will ultimately try to look through to whatever firm has been tangentially involved in that advice, where the firm giving the advice is no longer in business. So in general, it would be the firm providing the advice, but there's potential for some ongoing risk still.
I think it's that last man standing, isn't it? When everyone's gone out of business, there tends to be the line of inquiry goes through to the people who are still in business. So we would say that
Trying to find the insurance pot is how I put it.
yeah. So I think generally we would say that if a third party was used to give the advice, then they should be the one that has liability, but it's difficult to give a definitive answer because, yeah,
If they're not there in the
if
future,
they're not
then
there,
what
yeah.
happens? Well, one of the other questions that we cover off in our exit readiness assessment is around the due diligence that's done on third parties that you use. So, to just outsource to somebody that can complete the transaction for you probably isn't enough. It's then what due diligence have you done on that party that you've outsourced the work to as well. So if you've not, if you are outsourcing that DB work at the moment, then it's definitely worth just making sure that you yourselves have due diligence on file for the company that you're referring that work out to.
Thank you. And another question that was submitted beforehand was around, is now a good time to do a past business review based on the fact that most calculations are no loss?
Yeah, so we haven't really talked about the other side of the coin yet, have we, really, in terms of if there isn't suitable advice, what does redress look like? Because ultimately that's what purchasers are concerned about, and that's what FCA is concerned about in terms of consumer harm and any potential liability coming out of that. So your redress calculation is comparing the value of the DC fund today related to the transfer and comparing it against the value of the defined benefit pension benefits given up. And that isn't, the DC value is just the DC fund value, or something different if they've taken an annuity, allowing for withdrawals. And then on the DB side, that's an actuarial calculation of what is the present value of those benefits. And the approach to doing that calculation is specified in the regulations. But the calculation on the DB side, one of the key assumptions is the discount rate, and that is linked to the yield on government bonds. And we have seen significant change in government bond yields in recent years. And so redressed values now on DB transfer advice, particularly that 2015 to 2018 period, have fallen significantly compared to a few years ago. A few years ago, redress calcs were showing 5-figure losses on almost every single calc. The position has changed significantly now. We do a lot of redress calculations, and we're currently seeing probably about 80% plus of redress calculations on DB transfer showing no loss. And where there is a loss, it may be around 20% of the transfer value on average as the average loss for cases where there's a loss. Now, I would say those are very, very individually calculations. Every DB transfer calculation is different, but so you can never be certain, but the trend is a significant reduction in redress values. And so the nature or the limitation of the redress methodology is that it's a point in time calculation. It is a once and done at the point you do the redress calculation. Ultimately, with retirement benefits, whether or not someone has lost out won't be truly known until the last benefit is paid before they die and what they've fully received. But because it's a once and done calculation, if it shows no loss, you do a compliant calculation and you provide that to the consumer, they haven't got the right of recourse to come back in a year's time if market conditions were to move negatively to ask for a further calculation. So from a market conditions perspective, at present, it's probably the lowest level of losses we have seen in years in terms of redress values. But there's no guarantee that will remain placed depending on what happens to market conditions in the future.
So if people are thinking about it, now's probably quite a good time to kind of push on and get it done.
Yeah, the likelihood at present is that redress values will be significantly lower than they have been in previous times. And as you say, we've seen a significant number of cases which are no loss. So, but even if you're thinking about a full past business review, and it sounds very daunting when we work with firms, the advisors are very, very concerned about that. Once you go through a process which involves an opt-in, and again, we see it really varies by population, but say between 20 and 80% opt-in, probably on average about 40% of people opt-in. And those who are existing clients of firms probably opt-in at a lower rate because they're generally comfortable with where they are. Once you've gone through an opt-in process, that reduces the overall population. Once you've gone through a suitability process, the suitable cases fall out and that reduces the population. And then once you get to a redress point, if circa 80% of calculations are showing no loss and you have PI cover for the remainder, the overall position perhaps isn't as scary as it might look at outset.
And Vicky, would you say it's obviously having doing a past business review covers the cost? You know, if you bring external experts in, there is going to be some cost incurred. Do you think the cost of doing the review is outweighed by the benefit when it comes to the actual sale point?
On balance, I would say yes. I think, and I think that yes is probably going to become more of a strong yes as we move forward as well, and as that competition piece does, continue to increase. There are all sorts of changes that can happen as you go through a sales process if the buyer, or when the buyer, I should say, takes a look at that DB book through their own lens. Now, that could be that a buyer turns around and says, we're not going to acquire the shares of your business anymore. We're going to acquire the assets of your business. The tax implications, where a buyer goes from a share sale to an asset sale, you can be looking at up to an additional 25% in tax that ultimately the sellers pay before they receive that money's out. It's not as simplistic as that. There are certain allowances and stuff like that you can use to reduce it down, but any which way you shape it, the tax implications of having to sell your assets as opposed to your shares can be extensive. And therefore, in those scenarios, it would, easily be worth it from a cost perspective, undertaking a review. But there could be other things as well, right? You might have just invested 6 months in going through an exit process. That is not an easy process at all. Even to get to the point of due diligence, you've gone through a lot. You've met a load of suitors, you've negotiated on deals, you've got through heads of terms, you've invested emotionally and physically a lot in that process to get to that point. A buyer could then pull out, in which case you've just spent any cost you've incurred and all the time cost you've incurred on getting to that point. They could chip at the deal, and it doesn't take much to move a deal multiple one way or the other, for it to have quite a significant impact. They could escrow some money, or most likely they will undertake a review themselves, with a view that if any of those cases aren't deemed as suitable, then the seller would pay the redress anyway. So the reality is that this type of advice is probably always going to come back onto the selling party. And so the theme of kind of what we're discussing throughout, which is, do you want to take control of this, or do you want somebody else to? I think in my view, on balance, it's definitely worth taking a look at sooner rather than later, and then working out if a review in full or in part is the way to go.
And what's the current feeling from buyers in the market, Vic? Is DB still like a real hot potato? Does it make or break a deal? Are buyers more willing to consider it now that the redress stuff is a bit lower? What's the
Yeah,
general feel?
definitely not as noisy as it was. I mean, in was like this whole DB thing, and then we've had consumer duty, and that's really shifted the focus to ongoing reviews, and rightly so. And by the way, the rules around ongoing reviews have been in place since 2013, and then kind of really re-emphasized around MiFID. So, consumer duty and the importance of reviews shouldn't have come as a surprise to anybody. But that area of what they're acquiring, which is ongoing client relationships, is where I would say the biggest spotlight is on from buyers. They'll want to understand your review history for the last 6 or 7 years, and they can randomly spot check across that 6 to 7 year period. We're seeing many more sellers now, or business owners, actually send review cases for file checking as well, because that has become an area of increased scrutiny. But DBs are still very much up there. One of the things that, of course, the buyer is going to look at is the PI policy. So if they're acquiring the shares of a business, they want to ensure that the PI policy that's attached is fully comprehensive. We had one seller who started the process of sale, and they themselves actually had chosen to not cover their DB cases in their PI insurance. They decided that they wanted to hold additional capital adequacy. They were comfortable with the book of business and the clients that they were reviewing. And the increase in premium was significant, right? This is going back 4 or 5 years. I said to them, guys, you've got to speak to your PI insurers, right? You want to sell the shares of your business. Like, a buyer's going to want to know that you've got full coverage in place. So can you speak to your PI insurers and see about that? They did. They managed to get all of the cases covered. It hardly even moved the dial on the premium, which aligns in with what Ben was saying earlier on. Like, there was a moment in time where it really impacted on premiums. I think more and more owners now are surprised when they go for a requote. So, and the excesses weren't horrendous either. So getting if you can get that full PI coverage, then making sure you've got that is really important. But I would probably say the thing that's had the biggest, or given buyers the biggest wobble, and this is where I'd be interested in Ben's views, was a little paper that came out, consultation paper 23/24 by the FCA. And in there, the FCA said their expectations around buyers, or started to set their expectations around buyers actually taking that liability even when they've not acquired the shares. Okay, so if you want to acquire the assets of that business and you are a very large acquirer typically, and is starting to sort of work its way down, but the FCA's views are that that buyer should take that liability. And so that kind of shift from buyers being able to say, look, we're not comfortable with the risk profile, so we won't buy the shares, we'll buy the assets instead. Actually now we've got a number of acquirers who are saying to us, we can't even acquire the assets where there's DB cases, because the expectation is we're going to take on the liability for those. And therefore it kind of puts us in the same risk position. Ben, I don't know if you're finding the same around that nervousness, and if you've got anything to add.
Yeah, no, that's absolutely the case. You say the direction of travel from the FCA on this is very, very clear, that there have been too many instances of asset purchases specifically to leave behind potentially material liabilities with potential significant consumer harm. And I think the FCA is getting to the point where it's had enough of that now and is really starting to clamp down on that, particularly among the larger consolidators in the market, with a view of avoiding significant liability and harm being pushed onto FOS. So I think you're right. It's getting to the point now where it isn't as simple as saying we'll do an asset purchase, exclude the DB, and then everything will be fine going forward. There is an expectation that both parties involved in the transaction will find a way to limit the consumer harm caused as a result of the transaction, either through someone retaining the liability for the legacy DB advice, or by demonstrating the low likelihood of consumer harm through work having been done prior to the transaction.
Thank you. We've had another question come in. If you do want any questions answered, we've got about 5 minutes left on today's webinar, so stick them in the Q&A. There are a couple of pre-submitted ones I'd really like to get to. This was a follow-up, I think, on a previous question. So this is, what liability do you have if clients did a DB transfer somebody else and then have transferred service into you? So they were with advisor A, did a DB transfer, they've fallen out with advisor A, they've moved to you, advisor B. Do you have any risk at all if they have previously done a transfer under somebody else?
No, I think the short answer is no. If an advice firm has done the DB transfer advice, they've ultimately fallen out with that advisor or choose to move away from that advisor to you, you had no involvement in that DB transfer at the time, then no, there is never going to be a recourse or chain that comes back to you as part of that. It's only if your firm provided the advice or potentially was involved in the advice chain at the time of the advice.
With the exception of the large acquirers now, that they are expecting to take that on because those buyers are acquiring those client relationships. But yeah, no, in that example you just gave, Ben, there's not that risk attached. I think one of the things I'd just like to touch upon with a bit of time that we've got available is, and this is one for you, Ben, Benji, a lot of people are set up protected by a limited company. There will be some people, I'm sure, who are listening today who will listen to this afterwards that, are sole traders. So technically the liability, is with them. They sell their assets, let's say, and there is that nervousness that they are going to be sat on a beach in 10 years' time trying to enjoy retirement, and all of a sudden, they get the knock on the door. Would you say, therefore, that for those sole traders to really draw a line in the sand because they don't have a physical business entity that can is either going to pass this on to a buyer or, eventually through runoff cover, will be closed down and will disappear. Do you think it's even more important for those sole traders to draw that line in the sand and do that review?
Yeah, I think every circumstance will be different, but I think you're absolutely right in terms of that tail risk and that potential legacy risk. Because as we've talked about, DB transfer risk and harm, and it doesn't crystallize for a number of years. It's got a very long tail until people are in retirement, or particularly the latter years of retirement, and they find they've run out of money, and that's the point at which they make a complaint, for example. So yes, I would agree, Vicky, in terms of as a sole trader, potentially really addressing the issue at point of sale will remove that tail risk.
Yeah. Okay.
We've had another question pop through. If the transfer advice was done while the firm was part of a network, is there a possibility that there could be a look-through liability with the firm or member? That's a bit technical for me, to be honest. If you guys...
So for Ben. Network members, Ben?
Yeah, I think maybe it's if we can potentially take that one away and follow up on it. But I think, again, every case in consideration. I know there's a lot of, I think there's a court case or two at the moment around networks and where liability sits in terms of flow through. So potentially, but we could perhaps take that one away and follow up after the webinar.
From my experience of being in networks, it tends to come down to the contract and how the contract between the AR or the RI and the network and how that works. But we will follow up with that one. We will come back to you with an answer on that one. Closing minutes to go. Question that came in beforehand: how long does a full PBR take?
It's a good question. It's a little bit how long's a piece of string. Again, it depends on the population. It depends on the scale of it. Obviously, there are certain kind of timeframes that have to happen. So you need to review files. That sort of just depends on resource and availability of data. Any customer contact process, the typical approach, and one the FCA use on a lot of their past business reviews that they're involved in, is you write to a consumer, you send a chaser letter 2 weeks later, and then you send a closure letter 2 weeks later than that. So it's a 4-week customer contact period typically for any contact, be that getting data, be that doing an opt-in, be that around data gathering for redress. And then the other thing on timescales is the redress calculations themselves. The ways the rules are set up, the calculation date for any redress calculation is the first of a quarter. So you take a DC fund value at the first of the quarter and market conditions at the first of the quarter, and you use the same conditions for the full quarter, but you have to issue a redress calculation in the quarter that it's calculated. And so if you trip over into the next quarter, you've got to do another redress calculation. So there are a few things which constrain your timeline depending on when you start and the size of your population and how quickly people respond. But you're probably looking at 3 to 6 months end to end for a moderate sized population.
Brilliant. Thank you very much, Ben. And that unfortunately brings us to a close today. We have run out of time together. Thank you everyone for joining us today, and thank you for all your questions. I certainly found the discussion interesting, and hopefully it's been genuinely valuable to you as well. We'll be making the webinar available on demand shortly. Please feel free to share it with anyone you think would benefit from today's content. If you'd like to speak to Melo about selling your business or Isio about DB transfer reviews, please tick the appropriate box in the post-webinar survey. And for those of you who want more Melo, we'll be releasing next quarter's webinar schedule very soon, so keep an eye on your inbox and our website. Before you go, a quick reminder to join us for the big festive FS quiz of 2025. This is our end of year celebration for the entire financial advice community. We'll be quizzing some FS celebrities. We've got Abraham from Timeline, Kathy from Verve, and Alan Smith from the Trap podcast. We'll be quizzing them live, but you can play along on our quiz app, either playing as an individual or a team, and there's a £1,000 cash prize for the highest score. We'll put the registration link in the follow-up email that comes out after today's session. But yeah, just to close from me, thank you again for being with us today, and I will look forward to seeing you at the next webinar. Thank you.